Every modern state lives with debt. Some carry more, some less, but none stand outside the structure. This is often described as a crisis of excess, as if the problem was simply too many zeros on government balance sheets. But debt is not an accident layered on top of the global economy. It is the framework that holds it together. If every country owes, the more important question is not how much, but to whom, and why the system continues to function at all. Debt is commonly treated as a burden, something to be reduced, escaped, or paid down. Yet the modern world was built on the opposite idea. Long before digital money or central banks, long before stock exchanges and pensions, states discovered that the ability to borrow was more powerful than the ability to hard gold. The decisive shift did not begin in financial districts but in war, when rulers exhausted their treasuries and found conquest too slow or too costly. They turned to merchants and financiers. In exchange for steady interest payments backed by future taxes, private wealth agreed to fund public power. From that arrangement emerged a quiet revolution. Governments learned to spend money they did not yet possess, and lenders received something unprecedented, a claim on the future that could be bought, sold, and trusted. Once that idea took hold, it spread quickly. States that could borrow reliably could wage longer wars, build larger administrations, and survive crises that would have shattered older systems. Debt stopped being a sign of weakness and became a signal of credibility. To issue bonds was to declare permanence. To attract lenders was to prove legitimacy. Power no longer depended solely on territory or treasure, but on confidence. The battlefield shifted from land to ledgers, and the balance sheet became a tool of rule. Over time, this logic hardened into infrastructure. What began as emergency financing evolved into a permanent feature of governance. Debt markets grew deeper, more liquid, and more central to economic life. Entire institutions formed to manage, price, and trade these promises. Citizens, often without realizing it, became participants through their savings, pensions, and taxes. The same person who funds the state through taxation may also own its debts through a retirement account. Debtor and creditor collapsed into the same figure, viewed from different angles. This circularity is not confined to one country. It defines the global system. States hold one another's bonds. Central banks store foreign debt as reserves. International institutions recycle capital from one region to another and back again. Surplus countries lend to deficit countries, which return the favor by offering safe assets to park that surplus. Promises are stacked on promises, each one backed not by repayment in full, but by the assumption that the next promise will always be honored. At the center of this structure sits the modern central bank. Its role is often described in technical terms, but its function is philosophical as much as financial. When a central bank purchases government debt, it transforms one obligation into another. The state's liability becomes an asset held by the monetary authority, and new money enters circulation as the mirror image of that debt. This is not a flaw in the system. It is the system. Modern money is not separate from debt. It is debt, standardized and made liquid. There is no pool of debt-free currency waiting beneath the surface. Every unit of money traces back to a promise somewhere else. For decades, this arrangement has endured because confidence has endured. Investors do not expect governments to eliminate their debts. They expect continuity. Bonds mature, new ones replace them, and interest is paid along the way. The principle is rarely meant to disappear. What matters is the belief that the chain will not break. As long as that belief holds, debt can grow far beyond the size of the underlying economy without triggering collapse. History shows that repayment has never been the true goal. Stability has. When confidence weakens, the abstraction becomes real. Markets reprice risk, interest costs surge, and suddenly the creditor is no longer invisible. Entire societies can feel the consequences within months. Public services shrink, currencies lose value, and political order fractures under pressure. The response is often described as rescue, but it usually takes the form of discipline. New loans replace old ones, conditional on reforms that redistribute pain downward. The machinery resets, but it does not change its logic. What these moments reveal is not that debt has failed, but that trust is unevenly distributed. Some borrowers are granted patience, others are not. Some debts are treated as sacred collateral. Others are treated as mistakes to be punished. The difference is rarely moral, it is structural. The safest debts are those embedded deepest within the system, held by the most powerful institutions, and denominated in currencies that anchor global trade and finance. These debts are not expected to vanish, they are expected to circulate. This is why the idea of paying off all government debt is less a solution than a misunderstanding. Removing the most trusted liabilities from the system would drain it of its primary stabilizer. Banks would lose their safest assets. Pension funds would lose their foundation. Money itself would contract. The goal, therefore, is not elimination, but management. Debt must remain serviceable, desirable, and credible enough to continue functioning as the backbone of markets. Yet it would be a mistake to say that we owe it only to ourselves. Interest does not flow evenly. It moves from taxpayers and workers toward those who hold financial claims. Over time, this channels wealth upward, reinforcing inequality alongside indebtedness. At every scale, the pattern repeats. Households, corporations, states, and the global economy all operate on the same engine. Credit accelerates growth, but it also concentrates power in the hands of those who control claims on the future. There is no single villain in this story. Creditors and debtors are not opposing camps, but interdependent roles. The system rewards participation and punishes interruption. Its greatest strength is also its fragility. It depends on perpetual belief, on the assumption that tomorrow will resemble today closely enough for promises to remain meaningful. As long as that assumption holds, the structure can expand, roll forward, and absorb shocks. When it breaks, the numbers on the page stop being abstract, and debt reveals its older meaning. Debt began as a promise backed by force. It evolved into a promise backed by trust. Today it functions as money itself. The modern world does not merely live with debt, it lives through it. And the question that lingers beneath every balance sheet is not whether these promises will be paid in full, but how long belief can substitute for final settlement.